Hello, everyone. Hope you all are doing good, fine, and happy. To start with, I have received an extraordinary response for the part one of fundamental analysis video, and that kind of motivated me to kind of come up with this part two video. So, here in this video, I'm looking to cover some other in depth parameters which I have not covered in part one so that we kind of do a complete fundamental analysis as a package. So let's go. So the very first important and key parameter to start with is the growth factor of the company. When I talk about the growth, it means the profit growth plus a bit of sales growth as well. Let's take the example of this company called Narayana Hrudayalaya. So you might have known that this is a hospital. This is an hospital, and it's been doing good for the past few years. So when you take this company, just go to the profit and loss section and scroll down. So you will see this compounded sales growth, profit growth, etc. Okay. So what you get here is the last column, you get the 1 year sales growth and profit growth, then 3 years, 5 years, and 10 years. So why it's TTM? TTM is nothing but it's a 1 year data. It's nothing but trailing 12 months. Okay. So let's look at the profit first. Okay. For the last 1 year, the profit has been 54%. Okay. So which is a good number. Um, then go for 3 years and see. It's good 67, 63, 49. So these are all extraordinary numbers. So for the past 10 years, the company has been giving the profit of almost 50% and more. That's an extraordinary profit growth factor, right? So this is one parameter to check. The other thing is, apart from profit, one should also check the sales factor as well. So why? Because normally every company will have some kind of target for profit. So in order to achieve that, let's say the sales is poor, right? So in order to show the net profit as high, probably the company would do some cost cutting, save some money here and there, just to ensure that they are showing a great profit. Okay. So that is not something we want to see. What we want to see is profit is also growing at the same time. The sales factor is also, the revenue is also growing a bit. So maybe to draw a line and to keep a cutoff, a profit of 30% and more is a good profit growth rate, and probably a sales percentage like 15 and above or even 20 and above to support this factor would be better. So if you consider the profit and sales factor together, then it's a right parameter to check the growth factor of the company. So let me also show another example. Tata Motors. If you come to the profit and loss section, you see the past 4 years from 2019 to 22, the company has been reporting loss. I think it's from last couple of years. I mean, the 23 and 24 is when there is a profit uh, journey has started. Okay, so you see this company, the sales growth is 33%. Okay, which is a good number for the past 1 year. And look at the profit, it's 496% in the last 1 year. So obviously for a person to start considering a company, obviously you would consider the time where it starts to grow, isn't it? So probably by looking at these numbers, we can kind of pick and say that okay, in the last 1 year, there is something growing, here as a profit. Uh, Rather, in the past 5 years, 10 years, the performance has been poor, right? So that's the example I wanted to show. So you see the Narayana Hrudayalaya where the profit and growth has been consistent, which is also one way of looking at a company before considering. And if you look at Tata Motors, It's something which has recently started growing, and it's growing in an enormous, tremendous way, like almost 500%. So this is also one way of looking at a company to consider and invest. So to sum it up, yeah, sales and growth factor, sales and profit growth factor is something we all should see at first before entering in a company. The next key parameter which I'm going to talk about is and very, very, very important factor while doing a fundamental analysis. Without that, you cannot do a fundamental analysis, and that is why the next few minutes of this video is going to be very informative for you. So the parameter is nothing but quarterly results. So I'm going to talk about what is a quarterly cycle, how it works, why it's so important, and why someone needs to track that consistently while doing a fundamental analysis. So please watch this video without skipping, as this is going to be very, very, very informative for you. Cool. um, Let me explain the quarterly cycle, what happens. Okay, so you take a company, they are kind of reporting the profit and loss in years, and that's what you see here, the numbers like 20, 21, 22, 23, etc. Okay, so along with this, the company also releases their results in every quarter. Okay, so how the cycle works is, consider a financial year is from the start of April. Okay, so April, May, June, so and so, December, then the next year, January, February, March. So the next year, March end. So that's when the financial year ends. So for example, the current financial year, it is like April 23, May, June 23, that is one quarter, quarter one. Then July, August, September 23, that is quarter two. I can show it in the quarterly results section. So this is quarter one, this is quarter two, then October, November, December. So that is quarter three. So October, November, December's results are published as December 23 results, and these are the numbers here. Okay, so the next quarter it will be like Jan, Feb, and March 2024, and that will be displayed as a March 24 quarterly result. And again, you sum up this June, September, December, and March quarter, all four quarters, and then publish as a March 2024 yearly result. Okay, so this is how the quarterly result works. Now, why looking at a quarterly result is very, very important. Why? Because out of all the n number of fundamental parameters you have to analyze, quarterly result is one thing which has got a direct impact on the stock price. It has the power to decide the stock price regardless of the company is good or bad. So let me show that with a clear example. Okay, um, let's look at this company called Gujarat State Fertilizers and Chemicals Limited. I have been tracking this company for the past 6 months. Probably I had a look at this company around last year, October or November. It came as a recommendation to me. So I started doing the fundamental analysis, and to my surprise, everything in this company looked good. All the numbers, PE, ROE, etc., etc. All the ratios and factors, no, everything seemed to be very good. And even the most attractive thing is that time the price was around 180, and if you see the book value, it's 307, and intrinsic it's 432, and it was available at 180. So it was a very much undervalued and good stock. So what happened at that time, uh, the stock price was kind of shot up. It started like increasing from 180, and within like 2 months it almost doubled. Like it went till 320. It was an extraordinary growth. So obviously there were a lot of investors who were very bullish on the stock, and they were buying this consistently, and there was a rapid growth in stock price, which I myself had witnessed. Then what happened, This company had released the quarterly result uh, for December month. I think they released somewhere in the Jan. Okay. So what happened is the quarterly result was a bit poor. The reason is if you compare the net profit, it was just 112 crores. If you compare it with the previous quarter, it's way below. Okay. And if you compare it even with the last year's December quarter, it's even more way below that. So profit is very less. And look at the sales. So almost from 3,000, it has come down to 2,000 in the December quarter. So same when you compare it with the last year December quarter. So it's a conclusion that this quarter result, that is, I mean, the quarterly result of December 2023 for this particular company is very poor. So because of that, what happened? Immediately the price started to come down. So you see here, again from 318, it has now reached 196. So that is the impact of quarterly result. Now, what happens is if someone is not tracking the quarterly result, there is a chance that everything else is good about the company. So they might have bought the stock at 318, and imagine what would have happened. So it almost 50% their wealth might have been destroyed. So that is what happens if you are not following the quarterly result. Okay. I will also show another example, that is Natco Pharma. So if I go to their stock price and chart, um, this is after the quarterly result of December. Okay. So what happened here in December, Natco Pharma has provided the profit of 213 crores, wherein if you check it with the last December, it was only 62 crores. So it almost four times the profit of last year's December quarter. So why we have to compare it with the last December? So this question comes right to everyone's mind. So why? Because these businesses work in quarters, right? A company would probably might do good in quarter one, might not do good in quarter four because of their business model. For example, let's say these consumer goods, the fridge, mixies, and all, during the year of like, I mean, during the end of the year, like Christmas period, at the year end sales. So that time you see a lot of movement in these sector, right? So there is a lot of consumer items getting sold. So definitely at that time, the quarterly result will be high for those kind of companies. So similarly, there will be another business wherein the profit will be made in the first quarter. So it's always better to compare uh, um, a company's results based on its quarter. So, for example, if I get the result for December 2023, it's advisable to compare it with December 2022 so that we know what is the actual growth in this quarter. So, in that way, it is four times the growth. And together, if you put these numbers, no, 420, 69, and 218, that comes close to like uh, this itself is, it comes close to 1,000 crores, and if you add the next quarter also, it might go till 1,200 crores. So obviously the number was very good. So that is why Natco Pharma, if you see after the quarterly result period, it has come from 839 till 164, so which is a very good price hike. So what I am trying to say is a quarterly result has got the power to either make a stock price from 0 to 100 or 100 to 0, right? So it's very very important that one kind of analyzes the quarterly result. Okay. uh, as we are talking about this kind of advanced fundamental analysis, I will also later explain what one should do when a quarterly result is poor. That scenario also I will explain, like whether to exit or whether to continue. So how to analyze that situation and take a decision. Okay, so I'll explain that later, but for now just understand that how quarterly result is impacting the stock price, and that's why it's very very important fundamental factor to consider. All right, the another parameter, the next one I'm going to talk about is one of the key ratios, and this is mostly to determine the valuation of the company. It's none other than PEG ratio. So many of us know about PE ratio. We have seen last time about what is PE ratio. So I'll just explain PE again, and I'll just also explain what is PEG and how it is used. So basically, in the last video, we discussed that the PE ratio should be on the lesser side. Okay, we just spoke like probably a 20 or less. Okay, so what it means is, for instance, PE. Okay, so let's say a PE of 20. Okay, you can write it like 20 by 1, right? Like price as 20, earnings as 1. So what it means is, in order to earn 1 rupee, you have to pay or invest 20 rupees. Okay. Imagine if the PE ratio is 40. It means 40 divided by 1. It again means that in order to earn 1 rupee, you have to pay 40 rupees. So which one is better? To earn 1 rupee, paying 20 rupees, which is lesser than 40 rupees, is better. So that's why a PE of 20 or any lesser value is a better PE ratio. Okay. Now, what is PEG? So, PEG is basically PE divided by growth of the company. So, if you go to the if you go to any website for some of the companies, you would be able to get this data, right? So, what will be the growth percentage of these companies in the next 3 years or 5 years? So, that kind of percentage you would be able to get from some of the financial websites. Okay, websites like Yahoo Finance, or there are a lot of websites available. Okay, so uh, when you talk about P to PG ratio for a P of 20, let's say there is a growth percentage of 20 for that company. Okay, so it means 20 divided by 20, which is equal to 1. Okay, let's say the same company is having a growth of 40%, double the growth, then the PEG will be 0.5. So what it means? The PEG should be lesser. In order to have a higher growth rate, it means the PEG should be lesser. So basically, PE talks about the valuation price to earning. PEG talks about the same valuation, keeping into account the growth of the company as well. So that is why PEG is even more reliable. So in order to say a company is having a fairly valued PEG, we can say the value should be 1. This is again a random number just for our understanding, and we can practice as and when we go further. So anything less than 1 is an undervalue. Anything greater than 1 is a overvalue. So I will show this Karnataka Bank. Last time we saw this example, we said like, okay, book value is high, intrinsic value is high, current price is less, it is undervalued. You see this company, PG ratio is 0.20. It's very lesser than 1. So this ratio is something which helps you to identify the validation of the company, basically to determine how much undervalued or overvalued the company is. Okay, so the next item we are going to see here is cash flow and cash conversion cycle. Okay, so when you talk about cash flow, to keep it simple, you take this year, financial year, basically how much cash has come inside the company, how much cash has been taken out of the company. Okay, so from operations, the company has generated 463 crores, which is the amount which has come into the company, out of which the company has invested 67 crores, which has gone out of the company, and financing activity 230 crores has gone out. So basically, outstanding cash in hand, the company is having 164 crores. Okay, so this is also something we need to kind of analyze and see whether the company is having enough cash in hand, so that they can bit of play safe. um, so cash flow management, how the company is managing, that is also an important factor. So those things you can check from this section of the screener. So the another parameter with respect to cash is, out of these ratios, basically you can look at this cash conversion cycle. Okay, so I'll take this example of Apollo Tubes, this company. So if you see the cash conversion cycle, so what exactly the cash conversion cycle means? It means, so you have the inventory, okay, you have the products in your factory, okay, let's say at some point of time you have to sell that in the market, and you have to generate cash out of that product, right? So the amount of time, the number of days it takes for you to convert the product into cash, so that number of days is called cash conversion cycle. So which is better? Whenever I have some stock in the sense, whenever I have the some load of inventory, goods in my factory, which is better? The sooner I sell it and make a profit, that is better than I keep it for like 100 days, 200 days, 300 days. So the lesser the cycle, the better it is. So here you see this example. Initially, it used to be 82 days, and they have gradually decreased it. And in the current year, it has come to zero, which is very good, right? So these are all the parameters as well with respect to cash. One can have a look. Um, I was reading one of the blogs of an ace investor who has identified some good number of multi-bagger stocks. What he had mentioned in his article was, he identified one of a company as a very good company, fundamentals, technicals, everything was perfect. So he invested in that company, and he thought, based on his experience, his success rate, he used to think that that company is going to generate huge profit. But end of the day, the company ended up in a loss. So he kind of went back and further analyzed and checked what is wrong. Everything looked fine, but what looked wrong was the cash conversion cycle. Basically, the number of days it takes to convert into cash, the number of days the debtors are paying back the money to you. So these days should be lesser for a business. Rather, in that company, these ratios were high. So meaning the value has not been converted as cash and come back to you on time. So because of that, gradually the company ended in a loss, and the stock price also fell down. So I just wanted to quote this example to highlight the importance of these cash ratios as well while analyzing a stock. So yeah, it's better to know them, and take them also into consideration while analyzing a company. Well, now we have come to the final part of the video, where I'm going to talk about what is that one thing which differentiates between the ace investors and normal investors while doing a fundamental analysis, right? The thing which differentiates between an ace investor and a normal investor is how deep they can go further and analyze a company. So, whatever the ratios, the numbers we have seen, that is something a normal investor will analyze. Okay. But what further someone can do? Um, an ace investor, a successful investor, what he will do is he will go one step further and read the company's annual reports, con calls, see the presentations, you know, attend the investor analysis, investor and analyst meetings, right? So attend all these meetings and gather as much information as possible from the growth perspective of the company. So that gives the confidence and that gives the right direction when taking the decisions. For example, I showed one of the companies as an example, like Gujarat State Fertilizer Company. They provided a bad quarterly result and then the stock fell down. Okay, so there are two things one can do here. One can just exit because you are already in profit and the quarterly result is poor, so you can exit so that you don't want further loss. Or if you are very much sure that okay, this downfall is for just one quarter and maybe in the future still this company is going to grow and provide good results, then probably you would not exit, you would hold that stock. So in order for you to gain that confidence, you would have already read a lot about the company and probably you would have understood that there is something wrong happening in this particular quarter, because of that this fall has happened, and maybe in future the prospects are looking good. So that kind of level of understanding comes when you read about the company deeper and deeper and deeper, like attending all the meetings or going through their minutes and analyze all their presentations and see what they are doing. So this is one example which an ace investor does apart from what a normal investor does. Okay. So another example, this is a live example I wanted to show or I wanted to share here. So I was referring to one of the books where another good investor. So he just mentioned like how he was analyzing a stock, and also I was trying to read his mind, like how he analyzes. So apart from analyzing all these ratios, results, everything, he also did one thing additionally. He went and he checked the age of the management, that is the CEO. So the company's higher management, it was run by an husband and wife, and they were bit pretty old. Okay, so basically that's a risk because they are prone to health issues. So it's a good, the business is growing good, but what if the management changes? Because people get old at some point of time, they have to step down, right? So this is a risk. So he also analyzed further and found that they have already onboarded their son and daughter as the board members. They are already given some of the responsibilities, and now they are in a position to take up that senior managerial role and run the business whenever their parents are stepping down. Okay, and if that happens, the son and daughter, they would take the business and run it successfully with the same formula and same pattern. All right. So this is what he analyzed and found, and he stayed invested. Okay. So why I'm saying this example is, see how deep the investors are going and analyzing a company, right? So for me, these two examples, no, you should always keep in mind. The thing which differentiates an ace investor from a normal investor is how much information they know more about the company apart from what the ratios and numbers we are seeing on screen, right? How much effort they are putting in, to read the news of that company regularly, attending their meetings, reading their minutes, taking the inputs out of it, and see a picture clearly what is going to happen in next quarter, what is going to happen in next 1 year, what's going to happen in next 5 years. So this kind of vision, if you are able to gather by analyzing all available data as much as possible, then of course you will definitely become an ace investor by doing a proper fundamental analysis. So that's all I wanted to share, and I hope you found this series of videos enjoyable and informative. This concludes the fundamental series, part 1 and part 2. If you have liked it, please like my video, put some comments, so that would kind of get me a picture of what you think about it. And please do subscribe my channel, that would motivate me further. And please do share my channel link with your friends and family, and ask them to subscribe and follow me as well. Thank you so much. I'm looking forward to put more effort and come up with more and more such videos which are useful for all of us. Thank you so much.